Welcome to the Transparent FX Academy. In this video, you will learn exactly how you're supposed to be analyzing the market. So we will be taking a pair, analyzing it from a technical and order flow perspective to understand which zone we have to be looking for a potential trading opportunity. Now, if you're new to the channel, I'm a top author on the TRADINGVIEW platform and I share free education and analysis on all my platforms daily. So I suggest you subscribe and I will see you in the video. Today, we will be speaking about two very important and interesting markets to follow at the moment for a potential trading opportunity, and I will try to keep the analysis as educational as possible as usual. Now, let's start from the weekly time frame of US oil, what kind of situation we have from a technical perspective on the weekly. Now, from a technical point of view, we can clearly see that the market has created a W formation, specifically a W formation with the creation of a higher high. Okay, this is a bearish W formation, and the completion zone of this pattern is exactly the neckline. Basically, it's the completion zone is the previous resistance, now turned support from a weekly perspective, as we already said. So we want to see the market provide a retracement, and that is the whole idea of this pattern. If after the market has created a lower low, the retracement actually creates a higher high, at that point the market is overextended to the upside and you want to see the market make a retracement. A retracement to where? We already said it, to the neckline, aka the previous resistance, now turned support. So what we want to do here on US oil is see the market make a move to the downside to this level here. Okay, specifically this previous resistance now turns support because the market clearly has created a bearish W formation and we want to see the move to the downside. What we also know is that after a market has created an impulse, okay, the market is supposed to create a retracement. No market just moves straight to the upside without giving ever some kind of retracement. So we're supposed to see a retracement so that the market can go and grab some liquidity. But if we want to measure the retracement, where are we supposed to be taking our Fibonacci? Now, if you want to measure a retracement in the market, you're supposed to be taking your Fibonacci on the impulse. So from the low to the high of this impulse. And what we can see is a little bit a problem because the 0.382, which is the first strong Fibonacci level that the market is supposed to retrace to, is below the structure that we have on the weekly, meaning that they are still not in confluence. And what this tells us is that the market might actually decide to go a little bit higher, okay, for example, up to here, to make the 0.382 be in confluence with the structure, meaning that they're indicating the same zone as a strong support area, which is a concept that we spoke about many times. Most of the time, the Fibonacci levels will align with structure. If you see, as it is right now, that the 0.382 is not lining up with the structure, it is a problem because it means that probably this will not be the retracement zone for the overall retracement zone for US oil, or at least it decreases the probabilities of actually seeing the market making this move to the downside. So on the weekly, we know where is our downside target. Perfect. We want to see the market make the move to the downside. However, we keep in our minds that we still have the possibility to go higher because the Fibonacci levels are not aligning with the structure yet. Now, just a quick check at what we have from a COT perspective, so commitment of traders, what big banks and institutions are currently doing from a CAD perspective. Why? Because CAD correlates very well with oil, so we can definitely be looking at how hedge funds are positioned on this currency. Now, if we look at the net positions, okay, in the long term, we went from 38K all the way down to minus 35K, meaning that we went from having way more longs than shorts from an institutional perspective on the CAD. In fact, we had a 74K longs and 36K shorts. And now we have the completely opposite scenario here because we have way more shorts than longs, 23K longs and 58K shorts. And that is the long term. Okay, in the long term, we have seen hedge funds start to short the CAD. But if you look at the short term, okay, instead of the long term, we can see that we went from minus 35 to minus 24. And with the last report, we can see that hedge funds added 2.5k longs and closed 5k shorts on the CAD, which, as we said, is correlated with what we have on oil. So can we expect a retracement? Yes, before the continuation to the upside. So up to now, everything is combining, okay? We can definitely expect the completion of the zone to fetch some liquidity before the continuation to the upside. Now, if we go down on the daily time frame and see what kind of situation we have, we can see that overall what the market did on the daily time frame is to create this move to the downside, go and grab some liquidity here at the previous daily resistance, now turn support, creating this overextended M formation to the downside, and obviously the market rejected to the downside. If you see the market create an M formation, overextended, testing a support level, you definitely want to see the market make the move to the upside to test the neckline and potentially break even higher. So definitely from here, after the market created the overextended M formation, retesting exactly the previous resistance turn support, you definitely want to see the market make a move to the upside, and that is exactly what the market is doing. Now, the last daily close, okay, yesterday's daily close is still below the previous support turn resistance. So we still don't know if today's daily candle will actually break above the area or will respect the zone to the downside. But in general, is the US oil market an interesting market to follow at the moment? Well, this is exactly the decision zone for this market, and that is why it is interesting. Now, we must be extra cautious if we are to be looking for a potential trading opportunity on US oil. Why? Because we know that yes, we have daily resistance here, right? Previous daily support now turned resistance at this area, but we still don't know if the market will actually close from a daily closing perspective below the area. If this daily candle will close back above the zone, we are not interested in any shorting opportunity on this instrument, okay? No shorting, because the daily support, if the candle closes like this, will be broken to the upside. So it will be daily support. Now it is resistance, but if the market will close above it, it will be daily support, because as you know, once a resistance level is broken, it's turned support. So if it will break, we will not be looking for any setups, because the weekly is bearish, but the daily is bullish on the other side. If this daily candle will reject to the downside and will close to the downside, then we will have previous support turn resistance here. We have, as we said on the weekly, an overall downside target at the neckline of this W formation, which we will make visible also on the daily time frame. So we will have an overall downside target, which is here. The market will, the market will reject to the downside, we have good probabilities of reaching that zone, creating this overextended M formation before the continuation to the upside, and everything would be combining for a nice longing opportunity from here and obviously shorting opportunity from here. So how we will be approaching this market with students? First, we have to wait for the market on the daily time frame to close. If it will close below, then inside of this area, we will be monitoring price action on the 4-hour time frame, waiting for the market to provide to us one of our valid entries. And as soon as the market will provide to us one of our valid entries inside of the zone, we will be taking first a nice short to complete the W formation on the weekly to the downside, and then at the neckline of the weekly W formation, we will be monitoring price action on the 4 hours for a potential longing opportunity and continuation to the upside. On the other side, if today's daily candle will close above the area, we will not be looking for any setup, because anyway, as we have already seen, the Fibonacci levels are not aligning with the structure yet. So we can definitely continue higher, as we have already seen at the beginning of the video, from a weekly perspective and Fibonacci perspective. Now let's go and see the other market, which is very interesting to follow at the moment, which is the GBP Turkish Lira market. Just a quick reminder, make sure you comment below and you let me know which pair or topic you would like me to cover or analyze in the next video. Now we have already analyzed it in the previous video this week, but it's definitely time to make an update. Now, from a monthly point of view, what we have here is clearly a W formation. Now, after a W formation, as we have already seen with US oil, what you want to see is the market make a move to the downside to complete the pattern. Specifically, you want to see the market reach at least this zone, which is the previous monthly resistance, now turn support. So the completion zone of the pattern. Now, if we go down on the weekly, what we can see on the weekly time frame, we can see that our target is very accurate. Why? Because this is our target that we have, okay, taking this wick here. But in general, in a market, okay, as we said previously, if you have an impulse as you have here, okay, because the market went high, created this red candle, broke back up, broke down, so created an impulse in the market. The definition of an impulse is a strong movement in the market that creates either a higher high or a lower low. In this case, the market created a lower low. And after an impulse, in a correction, what do you expect? You expect a continuation to the downside. But specifically, what you want to do is, if you want to measure the retracement, you have to take the Fibonacci on the impulse, as we have done previously. But if you want to measure the continuation to the downside, then you have to take the Fibonacci on the retracement. And this will give you a -27 as the downside target, which aligns with the target that we have already on the monthly. So the weekly target and the monthly target are aligning, which is exactly what you want to see, because it means the Fibonacci levels are aligning with the structure, and this is a very good downside target, since it also brings the creation of this M formation, retesting exactly previous resistance, now turned support. Now, after the impulse and the correction, where is this structure? The structure is this candle here. Why is this candle here? Because in all of this move to the upside, there is one candle which is not related to the move to the upside, which is this red candle here, meaning that the market reacted to the area. So it found resistance here. And since the level is now broken to the downside, this is again resistance at this zone. And in fact, the market is already finding rejections here, and we can definitely expect the continuation to the downside and the completion of this impulse, correction, and impulse pattern to the downside. Now, from a daily perspective, okay, what is the pattern? The pattern is very simple. Everything is pushing to the downside. Monthly is bearish, weekly is bearish, but the daily not yet. Why not yet? Because currently here we have daily previous resistance, which is now turned support at this area. So we have to wait for this zone to break to the downside. Will it break to the downside? We don't know it. If the market will not break to the downside, then it will just continue up, and we will have to adjust as traders to the new market structure. But if the market will actually on the daily time frame break this zone to the downside, then we will have the monthly, weekly, and daily time frame all aligned for a potential move to the downside, and that is exactly what we will be waiting for with students. In fact, if the market will break the zone to the downside, the market will create this M formation. And after an formation, we want to see the retracement to the neckline. So what we will be doing? First, inside of this area, we will be monitoring price action on the 4-hour time frame, because always remember, monthly, weekly, and daily is for direction. 4-hour is for entry. So after the break to the downside, we will be monitoring price action on the 4-hour time frame inside of this area, waiting for the market to provide to us one of our valid entries for a nice short-term move to the upside to retest this structure. And then here is where we will have the best probabilities and best risk to reward, and where we will definitely be looking for a potential shorting opportunity. So we will be waiting inside of here for the market to provide to us one of our valid entries. And as soon as the market provides to us one of our valid entries, we will be taking a nice short with a very good risk to reward and very good probabilities for the move to the downside and completion of the monthly, weekly, and daily patterns to the downside. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free education and analysis for all of you. Also, make sure you go and check out the mentorship program. You find the link in the description. It's a very complete program. You first learn all the rules of my rule-based strategies, and then you trade them with me each and every day. In fact, I give you a complete market breakdown showing you exactly how to apply the strategies with entry, stop, take profit, and I also answer every single question that you have every day, including the weekends. So it's a very complete program. I suggest you go and check it out. The link is in the description, or I will see you in the next video.